our recent action has been to raise our view on China because of this policy shift, which we're characterizing as kind of taking out left-tailed risk to growth, which could then result in both a solidification of growth and earnings, but also an improvement in valuation. I'll give you some numbers in a moment. And we've actually just 10 days ago took our view on India down. We've been overweight for quite some time. Nothing to do with tremendous enthusiasm for the long-term growth potential in India, but feeling two things. One, that the market was trading at very elevated valuations, over 24 times earnings, really at the peak that it's been, both in absolute terms and relative to other markets. And then number two, there's a pretty widely accepted, understood mid-cycle correction taking place in the economy. And at the micro level, the earnings season for third quarter of calendar year has been on the softer side. It's more misses than beats. So when you've got a market that's done tremendously well and valuations are extended and retail investor sentiment is quite frothy, and you meet a bit of a reduction in momentum of both the economy and earnings, it seems that the market's probably overdue for a period of kind of time consolidation, kind of going into a trading range to let the underlying earnings catch up. So we took our view from overweight down to market weight and just want to be patient. We would fully expect to be re-engaging, but just feel that the time is not quite right until circumstances improve. Now, for China, our view is that this is a tactical upgrade. We've been very clear on mentioning or characterizing it as such. The reason being, and we've had a lot of conversations with investors about this, or questions with investors about this, the question being, is this the beginning of a new structural bull market, or that furious 35% rally that we had? And I think the logical answer is that there is just not enough evidence to make that assertion. You can't say that just because there's been a parade of very high-profile press conferences and indications of policy accommodation, that sort of magically waves away all the macro concerns that the market's been focused on.
What about the orange swan? If it is a Trump presidency, then and if there are tariffs and escalation in tariffs, then do we have to rip up the script?
No, I don't think so. So, as I was saying earlier, I think things are path dependent. A lot of it will depend on what sort of countervailing policy proposals that there may be to offset or buffer some of the impact. So the numbers that our economists have been working with are that, hypothetically, if there is a 20% levy on China tariffs that would be forthcoming, then that could be the impact of that could be something like 70 basis points on GDP to the downside.
So 4.3, 4.2 then.
Sorry.
From 5 to 4.3 to 4.2.
Well, actually, our numbers are from 4.7 to potentially 4.4. We're 4.7 for next year.
All right.
So, but the point is that there's likely to be some offsetting responses to that. Number one, there could be further fiscal policy stimulus, and a lot of would then forever depend upon the outcome of the NPC meeting. And then number two, we think that the currency would ease off, perhaps to maybe the 740, 750 level. So the combination of that suggests that the net impact might be something in the order of 20 basis points, which is not a colossal amount. And then we have to think, well, what would the impact on earnings be? And then we have to recognize that for example, the MSCI China Index, which we follow, is not a complete mapping of the economy. So we feel still pretty comfortable with our 10 to 12% earnings growth for next year. There might be some translation effect, because if the renminbi weakens, then you translate that back into Hong Kong dollar earnings. You might take a bit off because of that translation effect. But overall, if the larger setup for the market is that, as of last night's close, we're trading at 10.2 times forward earnings. We think earnings are growing, call it roughly around in the 10% ballpark. And we've taken out some of that left-tailed risk, as I mentioned, because of policy leaning in. And the guidance we had when we were in Beijing just a week ago was very much, look, more is coming, be patient, but we really want to support the economy and also the domestic equity market. We think the confluence of that with a market that's very under-owned and where sentiment is still quite soft could give us another 20% upside in the market.
Wow.
Yeah, I mean, the market went up 35% in 3 weeks. So,
Yeah.
that's not, that's not, over 1 year,
Yeah.
20% upside, which is the combination of going from maybe 10.2 times earnings to close to 12. So it's maybe 10% increase in valuation and riding 10% earnings growth. I mean, those are not crazy numbers to talk about.
Yeah.
And that's more than
extremely low base as well.
Yeah,
right?
and then to Shree's point or question, it's hard to see India going up 20% off 24 times earnings, right? And Japan, which we also sort of like longer term, it does have some challenges right now in terms of uncertainty about the macro environment, in terms of the pass-through of potential further rate hikes, et cetera. So we've had a somewhat more subdued view on the near term in Japan's market. And tactically, we've taken our view in India down, and tactically, we've raised our view on China. So that's kind of our logic of how we're getting to our views on those key markets.